Imagine stepping into a giant casino. Neon lights flashing, people cheering, stacks of chips moving across velvet tables. But this isn't Vegas. This is the global economy. Every dollar you spend, every hour you work, every loan you take, it's all part of the game. A game most people don't even know they're playing. The rules? Written by those sitting in private rooms upstairs. People you'll never meet. People who don't want you to win. This is the passive path. Today, I'm going to show you how this casino works. Why it feels like you're working hard but staying stuck. And how to stop gambling your future away. I'll reveal who really runs the tables. Why the odds are against the average person. And how to play the game on your own terms. Stick around. Because once you see the truth, you can't unsee it. And if you think you're safe outside the casino, think again. Let's see where you stand. Now continuing to part 1. The global economy looks normal from the outside. Banks, businesses, stocks, jobs. But under the surface, it's like a massive casino. Chips replace dollars. Investments replace bets. Winners take it all. Losers wonder what went wrong. Most people don't realize they're inside this casino. They're born into it. Go to school, get a job, try to save money. They believe they're playing fair. They don't see the dealers swapping cards, or the house always tilting the odds. The game is rigged. A small group writes the rules. Politicians, billionaires, big corporations. They shape markets. They influence laws. They bail themselves out when things go bad. Everyone else pays the price. Think back to 2008. Banks took wild risks. They crashed the economy. Millions lost homes, jobs, savings. But who got rescued? The same banks, trillions in bailouts, while families struggled to eat. That's how this casino works. The top players keep the winnings. The law, healthcare, student loans, credit cards. Big companies make the rules. The rest of us try to keep up. But you don't have to stay stuck. You can step out of the game, or at least learn to play smarter. This is why I started the passive path. Because the game doesn't end, but you can change your seat at the table and the levels of this casino. That's where things get even more interesting. Proceeding next to part 2, the 5 levels of players. Let's break down the 5 levels inside this giant casino. Each level tells you how close you are to the people running the game. The closer you are to the top, the more power you hold. The lower you are, the more you're gambling with your future. Let's start at the top, level 1. The big entrepreneurs. These are people like Jeff Bezos, Elon Musk, Warren Buffett. They don't just play the game, they help write the rules. They shape entire industries, change how we shop. Amazon started as an online bookstore. Today it controls huge parts of e-commerce, cloud computing, streaming, advertising. Amazon didn't just win the game, it changed the game. It sold books cheap, then sold everything else cheap. Other stores couldn't keep up. Many went out of business. Amazon grew bigger. Now Amazon can raise prices when it wants, because there's less competition. That's power. When big companies lose money, they get help. Bailouts, tax breaks, special laws. When regular people lose money, they're on their own. That's how the big players keep winning. They privatize the gains. They socialize the losses. The passive path wants you to see this, because the game isn't fair, but knowing how it works gives you a chance. But not everyone wants to rule the casino. Some people want to beat it in their own way. They're the entrepreneurs trying to build something new. Continuing next with level 2, startup entrepreneur. People with big ideas. They want to change the game. They see gaps in the market. They want to build the next Amazon. But the road is brutal. Look at Uber. For years, Uber lost billions. They slashed prices, paid drivers bonuses, burned cash to grab market share. Investors kept pouring in money. They believed Uber would one day control the ride market. Then Uber could raise prices, cut driver pay, and finally make profits. This is called winner takes all, but it's risky. Most startups fail. In North America, about 90% of startups close within a few years. Many never make a profit. Many can't raise enough money to keep going. Even with a great idea, you might run out of cash. Tech changes fast. A hot idea today might be worthless in 6 months. Bigger companies might copy you, crush you with more money. Think of social media apps. A small startup launches a new feature. Meta or TikTok copies it in weeks. The startup loses its edge. They create jobs, they push technology forward. Successful entrepreneurs share traits. They learn fast, they adapt quickly, they manage teams well, they don't quit when things get tough, but most people don't see the stress. Late nights, mounting debt, pressure from investors. The dream is freedom. The reality is survival. The passive path believes in business, but also in knowing the risks. Not everyone is built for startup life. Some people prefer a steady paycheck. They're the office workers. Continuing next with level 3, office workers. Level 3, office workers. This is the biggest group in the casino. People working jobs, 9 to 5, salaries, benefits. They think it's safe, they think it's stable. But the treadmill keeps speeding up. Inflation eats their paychecks. Groceries cost more. Gas costs more. Housing costs more. Even if wages go up, prices rise faster. In cities like New York or some spend half their income just on rent. College costs keep climbing. Parents worry about how to pay for their kids' future. Technology makes things harder. Artificial intelligence replaces jobs. Automation replaces jobs. A report says up to 800 million jobs could vanish worldwide by 2030. Jobs once safe are disappearing. Finance analysts replaced by algorithms. Paralegals replaced by software. Radiologists challenged by AI scans. Companies see workers as costs. When times get hard, layoffs happen fast. The idea of a job for life is gone. To stay safe, workers must keep learning. New skills, new tools. They have to prove they're worth keeping. Meanwhile, work-life balance suffers. Phones buzzing all night. Emails arriving at midnight. Stress builds. Health suffers. Relationships crack. Office workers also feel squeezed. Younger workers want promotions. Older workers try to hold on. Few management spots exist. Competition grows fierce. Some workers freelancing, driving ride shares, trying to build a cushion. But that's more hours, more stress. The passive path knows this struggle. It's why financial freedom matters. Because relying on one paycheck is risky. Many office workers look for a way out. Some turn to the stock market, hoping for faster wealth. Continuing next with level 4, retail stock investors. Level 4, retail stock investors. People trying to beat the casino, buy low, sell high, get rich. That's the dream, but the reality is harsh. The stock market is not always fair. Prices swing wildly. News breaks. Politicians tweet. Algorithms trade millions of shares in seconds. Small investors can't keep up. Big institutions hold the power. They have better data, faster trades, inside connections. The little guy often trades blind. Look at day trading. Over 95% of day traders lose money long term. It's not because they're dumb. It's because the game is People buy high out of fear of missing out. They sell low when they panic. They chase rumors. They chase charts. But charts can lie. Past performance doesn't guarantee future results. Big funds know how to trigger stop losses. They push prices down, buy cheap, then sell high. Small investors get crushed. Many think they've found insider tips. But real insider info rarely leaks to the public. Most rumors are traps. Another danger is overconfidence. A few lucky wins make people feel unstoppable. They start betting bigger, sometimes even borrowing money to trade. A single crash wipes them out. So how can retail investors protect themselves? Think long-term. Ignore the noise. Diversify. Don't put all your money in one stock. Consider index funds or quality mutual funds. And always know your limits. The passive path believes in smart investing, not gambling, because the market can turn fast, and in this casino the house always has an edge. But they chase luck in another way. They play the lottery. Continuing next with level 5, lottery players. Level 5, lottery players. People at the bottom of the casino, hoping for one big win. A ticket costs a few bucks. The jackpot promises millions. It feels like a chance to escape. But the odds are brutal. Look at Powerball in the United States. The odds of hitting the jackpot are about 1 in 292 million. You have a better chance of being struck by lightning or becoming president. Still, millions play every week. Why? Because life feels stuck. Wages stay low. Bills pile up. People feel trapped. The lottery feels like hope. A dream that a small ticket can change everything. But here's the truth. Most lottery winners end up broke. Some lose friends. Family turns on them. Scammers appear. People demand money. Many winners spend fast. They buy cars, mansions, trips. Soon the money runs out. Some go bankrupt. Some get depressed. Winning didn't solve. The lottery is often called a tax on the poor. Governments promote it as fun. They say funds go to schools, but it's built on false hope. It takes money from those who can least afford to lose it. Some people even get addicted. They keep buying tickets, thinking the next one will hit, but it rarely does. The passive path wants you to see this, because real wealth doesn't come from luck. It comes from knowledge, work, smart choices, and patience. So what separates winners from losers in this giant casino? It's knowing the hidden rules. Continuing next with part 3, the hidden rules of the casino. Let's talk about the hidden rules of this casino. The rules that decide who wins and who loses. Rule 1. Money makes money. It's called compounding. It means money earns interest. Then the interest earns more interest. It grows faster over time. Let's say you invest $10,000 and earn 8% a year. After 20 years, about $46,000. After 30 years, over $100,000. Without adding more money, this is why the rich get richer. They invest. Their money keeps working. People who don't invest fall behind because inflation eats cash. Inflation makes prices go up. Groceries, gas, rent. If your money sits in a savings account earning 1%, but inflation is 4%, you're losing money. Slowly but surely. This is why saving alone won't make you wealthy. You must grow your money faster than inflation. Investing is how you fight back. It doesn't have to be risky. Even simple index funds can beat inflation long term. The passive path believes in using time and compounding as your allies. Because the earlier you start, the less you need to save each month. But compounding alone isn't enough, because returns come with risk. Let's talk about that. Continuing next with Rule 2, risk and reward. Rule 2, risk and reward. No way around it. Think back to the 2008 crisis. Big banks sold risky loans, they packaged them into fancy products, told investors they were safe. Investors trusted them. Then the market crashed. Banks got bailed out. Regular people lost jobs. Homes, savings. This happens because big players shift risk away from themselves. They let others take the hit. It's the same in investing. Some investments promise huge profits. Crypto, penny stocks, options trading. They can skyrocket, but they can also crash overnight. Small investors often get hurt most because they jump in without understanding the danger. Risk isn't bad, but you must know what you're risking. Never invest money you can't afford to lose. Spread your bets. That's called diversification. Own different types of investments. Stocks, bonds, real estate, cash. This way, one crash won't wipe you out. The passive path believes in calculating because smart investing means staying in the game long enough to win. But risk isn't the only challenge. Information is power. Let's talk about that next. Continuing next with Rule 3, asymmetry of information. Rule 3, asymmetry of information. The people at the top know things you don't. They hear news first. They get inside data. They influence decisions behind closed doors. Regular investors get the leftovers. By the time the news hits the public, it's often too late. Think about company earnings. Insiders know how a company is doing before the reports come out. They might hint to friends, or drop small clues. Those friends buy shares early. Prices rise when news goes public. The insiders already made money. Regular investors buy at higher prices. Then the insiders might sell for profit. It happens all the time. Even though insider trading is illegal, some get away with it. And it's not just stocks. Real estate, politics, commodities. So how do small investors protect themselves? Don't chase rumors. Avoid hot tips from strangers. Stick to facts. Read company reports. Check data from trusted sources. Invest for the long term. Short-term trading is where insiders have the biggest edge. The passive path believes in building knowledge because knowledge is power, and patience protects you when you're not in the inner circle. But even knowledge can't save you if you're reckless. Let's talk about leverage. Continuing next with Rule 4, leverage. Rule 4, leverage. Leverage means using borrowed money to invest. It can boost your profits or wipe you out. It's a double-edged sword. Let's say you buy a house for $500,000. You put down $100,000. Borrow $400,000 from the bank. If the house price goes up 10%, you make $50,000. That's a 50% gain on your cash because you only used $100,000 of your own money. But it cuts both ways. If the house price drops 10%, you lose $50,000. Half your cash is gone, and you still owe the bank. Stocks work the same way. Some investors borrow money to buy more shares. If prices rise, they profit faster. If prices fall, losses explode. Margin calls happen. The broker forces you to sell, sometimes at the worst moment. Big institutions use leverage smartly. They manage risk. They have backup funds. Small investors often don't. They go all in, then lose everything. The passive path believes in caution. Use leverage only if you fully understand it, and never bet your entire future on borrowed money, because one bad swing can wipe you out. But even if you avoid leverage, there's one more danger: your own mind. Let's talk about that. Continuing next with Rule 5, Psychology rules the market. Rule 5, Psychology rules the market. Markets look like numbers, charts, graphs, but underneath they're driven by emotions. Fear makes people sell. Greed makes people buy. At the wrong times. People hate losing money. It hurts twice as much as the joy of gaining money. This is called loss aversion. Investors hold on to losing stocks too long, hoping they'll bounce back, but they sell winning stocks too soon, to lock in small gains. Another trap is anchoring. People fixate on one number, like a stock's old high price. They think it's cheap because it dropped, but it might still be overpriced. Then there's herd mentality. Everyone rushes into the same stocks because they're trending, or social media hypes them up. But crowds can be wrong. They often pile in just before prices crash. Confirmation bias is dangerous too. People look for news that supports what they already believe. They ignore facts that disagree. This blinds them to danger, and overconfidence is deadly. A few wins make investors think they're experts. They bet bigger, take more risk. The passive path teaches this, because your biggest enemy isn't the market, it's your own emotions. Smart investors stay calm, think long-term, and avoid panic. So how do you climb the pyramid in this giant casino? Let's talk about how to move up. Continuing next with part 4, how to move up the pyramid. You might be wondering how to escape the lower levels of this casino, or at least move higher. It's possible, but it takes effort. First, build financial literacy. Learn how money works, how investing works, how taxes affect your income. Schools rarely teach this. You must teach yourself. Read books, listen to financial podcasts, check reliable websites. Start small. Next, create multiple income streams. Don't rely on one paycheck. Consider side businesses, freelance work, online stores, investments that pay dividends, rental properties if you can afford it. Every extra dollar helps you build freedom. Third, manage your spending. Track every dollar. Redirect savings into investments. This isn't about being cheap, it's about building options. Fourth, protect your mental health. Stress destroys good decisions. Take breaks, exercise, sleep well, talk to people who support your goals. Avoid those who drag you down. Fifth, invest for the long term. Forget quick riches. Think decades, not days. Let compounding work for you, even if you start small. Sixth, know yourself. Some people love building businesses. Others prefer quiet investing. Don't follow trends blindly. Do what fits your skills and personality. Seventh, accept mistakes. Everyone makes them. Learn, adjust, move on. That's how you grow. The passive path exists to share these lessons, because wealth is built step by step, not overnight. Anyone can start, even with a low income. Small habits create big results over time. You have to choose. Stay in the lower levels, or fight your way up. This isn't theory, it's real. It's your passive, but you can stop playing blind. Continuing next with the closing. This casino never sleeps. The lights keep flashing, the games keep running, and the rules keep changing. But you're not powerless. You can learn the game, understand the odds, make smart moves, and refuse to be just another chip on the table. The global economy will always have winners and losers, but knowledge can shift the balance. You don't have to stay stuck in level 3 or level 5. You can climb higher. One step at a time, the passive path is here for that reason. To help you build real wealth, steady wealth, so you can live life on your terms. Start today. Learn something new about money. Cut one expense you don't need. Invest a small amount for your future. Tiny steps add up, because in the end, either you control the game, or the game controls you. Like, subscribe, comment your thoughts,